2023 financial results presentation. Jens Lottner, CEO, will begin with opening remarks, and Alex Becaire, CFO, will share more details of the financial results and business updates, followed by a Q&A session. Jens and Alex will present in English with live Vietnamese translation available via a separate link. We will have another call in Vietnamese tomorrow for retail investors. We expect today's presentation and Q&A to last about 90 minutes. With that, I'll turn it over to Jens to begin the presentation.
Good afternoon, everyone, and thanks for joining us for that analyst presentation on quarter one. Let me start off and just share a little bit perspectives of how we look at the first quarter, and then I will hand it over to Alex. So in terms of the overall environment, it is still a pretty tough quarter, and there are still headwinds in the economy. And we also, GDP and growth was 3.3%, probably came in a little bit below what everyone had expected. I think quarter two also seems to be still muted. There are a lot of implications still running through the economy from an also overseas effect. So in that context, we still believe that we had actually a pretty strong and good quarter. The TOI, while down year on year, is actually quite in line with our expectations. And there were some NIM compression, which we had advised earlier, and we will probably see that over the course of the year still, that NIM might actually go in lower than what we had seen in the past years. But again, Alex will probably give a little bit more guidance on that. But on the other hand, NFI were actually still pretty much in line and growing. And PBT down year on year, and mostly, as we said, TOI was coming in slower. But then also an increase in OPEX, even if moderate, of roughly 5% year on year, and as well as somewhat lower recoveries and higher provisions. And that is just reflecting, on the one hand, our willingness to continue on our investment path. So we are very convinced with our strategy of data, digital, and talent, and we continue to invest in order to be ready for when the economy turns. At the same point in time, we also want to be pretty prudent in this current environment, and where the headwinds are not just affecting the banking industry, but actually the economy overall. Return on assets still stays actually pretty robust at 2.9%, return on equity at 80%, and so these are still pretty good figures and in line, maybe not what we've seen in 21, 22, which were a little bit abnormal, but are still pretty strong measures, especially if you look on the ROE side, and that we are running still at a CAR of 15%, and much higher than the average of the industry. CASA down and overall, and we had a very strong deposit growth of 8.1% quarter on quarter. However, CASA is overall down in the economy, and so we also saw a certain drop, which basically brought down the ratio, while at the same point in time we actually gained market share over the last quarter. But the overall effect on still relatively high interest rates on credit growth, and therefore a tendency to self-finance, actually brought down CASA in the overall industry. NPLs increased slightly, but again, very much in terms and in line with the guidance and we gave, that we said, and this year we will be slightly higher, but well below 1.5%. And we also have still a pretty good buffer on the loan loss coverage ratio, with more than 130%. CAR, as I said, still pretty strong, 15%, little bit down, but again, given the fact that in the first quarter we actually grew our credit book quite aggressively, and it's rather explained by the increase of risk-weighted assets, and despite the fact that we continue to increase retain earnings and increase actually our capital. So, as I said, strong headwinds, but the overall performance, and especially when it comes to the quality of the book, is actually still very much in line with what we expected and what we had guided. With that, I hand it over to Alex, who will give you much more detail, and then after that we will go to the Q&A. Alex.
Thank you, Jens, and good afternoon, everyone. So I will start with an overview of the macroeconomic environment. The main point to highlight is the deceleration, as Jens mentioned, of Vietnam's economy, with a year-on-year GDP growth this quarter of 3.3% compared to 5.9% last quarter. The manufacturing sector in particular, which represents around a fourth of the economy, recorded a contraction for the first time since 2021. The main driver was the weakness of external demand, with exports falling, as you can see, 11% year on year. Fortunately, services, which represent around half of the economy, kept growing at a healthy rate. There were also some signs of easing. So inflation moderated to 4.2%, which is below the government's target, and the dong strengthened, recovering some of the ground previously lost to the US dollar. So the slowdown of the economy has therefore a flip side, which is the progressive release of the monetary pressure, which had led to the increase in interest rates and also to the tighter liquidity. Moving on to monetary indicators, we can see that the economy turned a corner this quarter. Interest rates starting to decrease by around 50 basis points for term deposits. However, government bond yields and interbank rates fell even more by 90 to 250 basis points. This means that maintaining liquidity buffers has also become much more expensive for banks, exerting therefore pressure on the net interest margin. As expected, credit growth this quarter has been much slower than in the same quarter of 2022 due to the high interest rates, the softer demand for goods. A significant fraction of economic agents are deferring their investment decisions or, as Jens mentioned, funding them through their own cash balances. And as a result, deposit balances in the market have grown by a moderate 0.8%, and CASA balances have continued to fall by around minus 10% during the quarter, according to our own estimates. So with lower inflation, growing FX reserves, as you can see, and the end of the US Fed interest rate hike in sight, we expect the downward trend on interest rates to continue. Looking at the real estate market, you can see on the left-hand side of the slide transaction volumes and prices for apartments in Hanoi and Ho Chi Minh. The key message is that the main impacts so far have been on volumes rather than prices, at least for apartments. For landed houses, the market is less liquid and therefore doesn't provide reliable benchmarks. On the right-hand side, you can see corporate bond issuances with, again, a sharp contraction compared to 2022 and even 2021. We started to see that said increased activity in March, which is encouraging. Finally, we thought it would be good to provide insights into some of the more recent regulatory developments in Vietnam. Overall, they contain tangible measures to ease the tensions in the economy. Impact, we think, will be felt in a number of areas. Improved bank liquidity first, through new calculations for LDR ratio, flexibility for issuers on bond restructurings, flexibility for banks on bond buybacks, although still with stringent conditions. And finally, importantly, debt restructuring program for individuals and businesses without impacting debt classification, similar therefore to what had been done for COVID. It is therefore a significant package of measures which will help address default risks in the banking and bond markets and will also support credit growth and business activity in the economy. Let's look now at the financial highlights that Jens commented on. Though in our last earnings calls, if you remember, we guided that the next couple of quarters would be challenging for margins and challenging also for fees. Our results for Q1 are broadly in line with our anticipations, even slightly better, actually, in some respects. So we continue to see pressure on our NIM, driven by the repricing of our TDs and also the market-wide erosion of CASA. The flexible pricing policy we have applied in order to support our customers also constrained our capacity to increase rates on assets. However, this is only temporary, as we expect to fully recover this revenue shortfall when the situation permits. NFI, on the other hand, proved resilient. Jens mentioned it, and our other income benefited from a 730 billion gain on the sale of our former Hanoi head office. Even if I exclude this one-off item, our PBT was still up 3% this quarter compared to the same quarter, to the previous quarter. Overall, I would qualify our performance this quarter as healthy. Our ROA, while down, still compares well with our peers. We grew our assets and deposits faster than the market. Our ROE arguably went below 20%, but remains, I would say, in a good ballpark, considering the temporary headwinds we're facing and considering also the size of our capital buffers. And finally, our CAR, our NPL, our coverage ratio all point to a healthy balance sheet. These slides provide an overview of our PBT. We will look at all the drivers in more details later. I will therefore only highlight a few points. First, the positive contribution of other income, which includes, as we said, a 730 billion gain on disposal of our former Hanoi head office. We continue to incur higher swap costs on our debt in US dollar, which masked the robust performance of our market activities across the various desks. Our recoveries, Jens mentioned it, were down 63% year-on-year. And this is because the first quarter of 2022 included the collection of two large receivables. Finally, our OPEX increased by a moderate 4.6% year-on-year, and we're down 21% compared to the previous quarter, which included the impact from seasonality as well as one-off items. All in all, we recorded a PBT of 5.6 trillion this quarter, which is the second highest among joint stock commercial banks. This shows the component of our NII in more details. Asset yields continue to rise from 8.2% in Q4 to 8.8% this quarter. The impact of the repricing was actually partly offset by the flexible policy we have applied in order to align the amount of interest that we accrue and collect from our customers to their cash flows. This ensures that our credit-worthy customers can continue to meet their debt obligations during this period of tighter liquidity. On funding, we grew our deposits by 8% quarter-on-quarter, which is significantly better than the market. We continue to prioritize the strengths of the balance sheet and increased the share of deposits in our funding from 64% in Q4 to 66% this quarter. Our cost of funds, as Jens mentioned, went up again from 4.1% to 5.3%, largely in line with our anticipations. The primary drivers were the continued repricing of our term deposits, as well as the erosion of our CASA balances in line with what we observe in the market. As a result, our NIM narrowed to 4.6% on the last 12 months basis. We expect that the NIM will see further pressure in the second quarter before hopefully bottoming out. The main reason why we think that the NIM will continue to experience pressure is the fact that asset rates in the market, as you've seen, are going down more rapidly than deposit rates. And this is particularly obvious for government bonds and for interbank rates, which together represent 17% of our assets. And then the second reason is the flexible pricing policy I mentioned earlier, and more on this later. Finally, in terms of asset mix, I would highlight the continued reduction of our corporate bond portfolio to 38 trillion dong at the end of Q1. We will now look at lending balances in more details. As you can see, our average credit yield went up from 9.4% in Q4 to 9.9% this quarter. At this stage, we have only partially passed through the higher cost of funding to our customers. The reasons are the overall dynamics of the market, particularly the strategy of the state-owned banks, which, as you know, experience a lower cost of funds, but also the flexible pricing policy we have implemented in order to support our customers. And as I mentioned earlier, the expectation that we'll be able to recover the pricing concessions made once the cash flows of our customers improve. The second point to highlight is the sharp increase in our credit assets by 9% quarter on quarter, which is significantly higher than the market. So we observed softer demand from SME and retail customers for reasons which have to do with the high interest rates, the cautious risk appetite, as well as slower growth of the economy. And at the same time, we saw strong demand from our corporate customers with pricing and risk parameters aligned to our underwriting criteria. And this explains why most of the credit growth this quarter came from wholesale banking customers. In terms of structure, the mix between short-term and medium-long-term at the end of Q1 is broadly the same as 1 year ago. This is another slide on our credit exposures. Our corporate loan balances have increased in total by 25% quarter on quarter, and in a range of 11% and 31%, depending on the sectors. For Recom, the quarter on quarter growth was 29%, which is a bit above the average. It doesn't mean that we have abandoned our objectives of diversification. However, as I said in previous meetings, there is a direction and then there is a timing. Our direction is clear and has not changed. We believe in the potential of the Recom sector for sure, but at the same time, we also want to build stronger presence in other sectors. But timing-wise, we also recognize that we have less flexibility at the moment to pursue aggressive diversification. And in a way, the fact that we wrote new credits in Recom also shows that our projects have a clear legal status and are moving ahead. It's the sign that this portfolio is active. Moving on to retail loans, the main components, as you know, is the mortgage book, around 86% of our exposures in the retail sector. Situation in the real estate market is the one we've seen, and this has impacted the volume of new mortgages written, leading to a reduction in balances due to early redemption. The trend, that said, in the later part of the quarter was more favorable, and therefore we hope that the situation will improve over the coming months. Unsecured lending, on the other hand, has seen some healthy growth this quarter. We are looking to continue to grow this portfolio as we are getting more and more comfortable with the effectiveness of our credit underwriting and fraud detection processes. Now, a quick focus on deposits. Overall, our deposits grew 8% quarter on quarter, which is faster than the market, and our CASA reduced by 6%, which is not the trend we were hoping for, but is still better also than the market. As you know, growing again our CASA balances and restoring the competitive advantage of Techcombank on the cost of funding is our #1 priority. But right now, it's fair to say that we are a bit swimming against the tide. The higher rates, the tighter liquidity, the lower investment appetite, all this mean that our customers tend to move their cash to TD or use it to fund their business. And these effects are compounded in our case by the profile of our customers with a higher proportion of affluent individuals and business owners. So to win market share in this challenging environment, we are deploying a number of different strategies, new propositions to drive main operating accounts, such as cash, liquidity management, merchant acquiring, payment collection. Second, new digital and strategic partnerships, such as the Wildlife partnership with Massan. We talked about it last quarter to dial up customer acquisition. Next generation rewards and loyalty programs to drive engagement. We are investing heavily in this area. And then, last but not least, innovative campaigns, such as the Meo Dai Cat gamification to drive customer awareness and acquisition. So it is a long game, but we are confident that our efforts ultimately will pay off. Let's look now at our fee income, very robust performance in this area, as Jan said. So card fees were up 300% year-on-year, thanks to tighter control of cashback expenses and a 150% growth of new installments for buy now, pay later, thanks to the improvements in our mobile app. Later, credit, cash, and settlement fees were up 177% year-on-year. Letter of credit, in particular, were up more than 300% year-on-year, so multiplied by 4. We continue to reap the benefits of our tailored digital offering, including advanced solutions for trade and also a new leading app for SME customers. FX sales were up 47% year-on-year. We saw strong volume growth, particularly for derivative transactions, up 104% year-on-year. On the other hand, and at the weak point this quarter, banca fees were down 11% year-on-year, in line, I would say, with market trend, in line also with a change in customer risk appetite. We are working hard to achieve our ambitious objective for this business, aided by a number of initiatives, including tighter sales management with the new CRM tool we have implemented with Salesforce, dedicated training programs for RMs, faster lead conversion, new marketing materials, and so on. IB fees, finally, and this is the other weak point in our net fee income, decreased 73% year-on-year, reflecting essentially the muted performance we saw of the bond market for most of the quarter, compared to strong origination activity last year. And as we saw, there are some positive signs that the corporate bond market actually might be gradually recovering. Turning now to operating costs, as Jens mentioned, cost growth this quarter was only 4.6% year-on-year, with a CIR normalizing to 33.8% after a spike in Q4, driven by seasonality and one-off expenses. So we continue to invest in digital and cloud technology, and this drove higher costs for depreciation and amortization, up 47% year-on-year, as well as premises and equipment, up 34% year-on-year. These investments, in turn, enable improvement in staff productivity, as reflected in the fact that our headcount this quarter continued to decrease. A quick focus now on asset quality, something that all of you are probably very much interested in. Provision expenses increased 145% year-on-year, driven by the growth and maturation of our credit books, while the first quarter of 2022 actually included provision reversals on our COVID support program. Our loan loss ratio stood at 0.4% on the last 12 months basis, which is quite low, as you know, by industry standards. The bank's non-performing loans increased only moderately to 0.85%, with a healthy coverage ratio of 134%. Our special mention loans, so bucket 2 ratio, went slightly down, actually, to 1.9% at the end of the quarter, from 2.1% at the end of the previous quarter. And this included actually significant loan reclassifications triggered by credit bureau. If I exclude this impact, then the bank's organic bucket 2 ratio decreased to 1.3%, almost a half. We recognize that the next few months for sure will continue to be challenging with significant risks, and some of these risks we cannot control. We'll therefore continue to stay close to our customers in order to keep our books as healthy as possible. We also wanted to provide more insights into the health of our credit books and following questions that we received over the past few weeks. So to summarize the key messages of these slides. So first, as you can see on the top left-hand side, the average loan-to-value on our books has remained broadly stable at 60%, which is quite healthy. The same goes for the amount of interest receivables at a proportion of assets. It's the chart on the left bottom of the slide. We are conservative as a rule and as a bank in our approach to interest rate recognition, and we always look to align accruals with payments received from our customers. In terms of the structure of our assets by interest rate bucket, it's the chart on the top right-hand side, we can see that the proportion of assets yielding 10% and more has increased significantly, while the proportion of assets yielding 8% and less, including short-term assets, is in the range of the last 4 quarters. And now looking finally at the average yield in each bucket, and that's the chart on the bottom right-hand side, we can see that it has increased for the higher bucket and reduced a bit for the lowest bucket as a result of our flexible pricing policy. And to repeat again, the objective of this flexible pricing policy is to ensure that the accruals are aligned to the payments we receive from our clients, and that the payments we receive from our clients are aligned with the cash flows of our customers. And once again, this concession is temporary, and we will look to recover the interest rate shortfall when the cash flows of our customers improve. So overall, we hope that this disclosure will help you understand the performance of our credit books from a wider variety of angles. Turning now to capital and liquidity, our CAR, Jens mentioned it, reduced slightly to 15% as a result of the rapid expansion of our credit books and remains still among the highest in the industry. On liquidity, the proportion of deposits in our funding continued to increase, reflecting our focus on maintaining a healthy balance between the various sources of funding. Finally, a glimpse into how our performance compares to peers. The overall banking sector, no denying it, seems to be in a rather good shape. Profitability of most banks improved last year on the back of credit growth as well as technology investments, and it seems that this trend is set to continue. Credit defaults have remained so far under control. On our side, we have faced significant headwinds, as you know, in the bond and real estate markets, where we had built strong commercial positions. And this is in this challenging context for Techcombank. It's not really surprising to see some convergence between our performance and that of the industry. However, we continue to maintain significant advantage on CASA, on NIM, and on efficiency more generally. And once the environment becomes more supportive for investment and risk-taking, we should see Techcombank again outperform the market significantly. We will turn now to the forward-looking guidance part of our presentation. For GDP, the economy is showing, as we said, some signs of slowdown, and we are expecting growth to be around 6.5% with a downside scenario at 5%. The environment remains challenging for sure, pressure on exports, slower real estate market, cautious risk appetite, translating into slow growth for bonds, for funds, and for stock investments. But against these headwinds, there are also some positive factors. The SBV first should continue to pump liquidity into the economy, buying US dollars and lowering interest rates. Fiscal spend should also increase compared to 2022, providing a stimulus for the economy. And then, last but not least, borrowing costs should moderate, supporting, therefore, investments. With that, let's look at our updated guidance for 2023. Credit growth will be, as always, in line with the quota that we will receive from the SBV and should be in the same ballpark as 2022. On cost of funds and NIM, we anticipate further short-term pressure, particularly next quarter, followed by some improvement in the second part of the year. On average, over the whole year, we now expect the NIM to be lower than in 2022. This is because of the market-wide issues I mentioned earlier concerning first CASA and second this disconnection between asset rate and deposit rates in the markets. NII growth rate should therefore be lower than in 2022, while fee income growth should be comparable to 2022 with a gradual acceleration through the year. For CASA ratio, clearly we hope to grow it again in 2023. For CIR, we will aim to keep it around the mid-30 level, which is our general guidance. We expect NPL to be in the same ballpark as in 2022, recognizing, however, that there are some uncontrollable factors, including the impact of the credit bureau. Finally, as we complete the reversal of COVID provisions, credit costs should normalize and get closer, therefore, to their long-term level. Overall, 2023 will be a year of consolidation in the growth trajectory of Techcombank. There's no denying it. We'll stay close to our clients in order to keep our books healthy, and we will focus on building our fundamental strengths, on new customer acquisition, on digital partnerships, on data-driven decision-making, on operational efficiency, and on customer centricity. These investments will hopefully make a significant difference once on the cloud, which currently overshadow our performance, dissipate. This concludes our presentation. We will have a short break before taking your questions. Thank you.
Thank you, Alex. We will take a short break and return at 3:30 in about 15 minutes for the Q&A session. During that time, please submit any additional questions to our IR team using the QR code or email address at the bottom of your screens. Hi, welcome back, everyone. We will now start the Q&A session for the first quarter 2023 financial results presentation. The first question is for Alex. Could management comment on the banking sector situation in the first quarter and April to date? Has liquidity improved, and what is the outlook for the rest of the year? And how does this outlook and the different scenarios translate into Techcombank's lending activities and NIM?
Yeah, thank you for this question, which gives me an opportunity to come back to some of the things we said about NIM. So overall, the banking sector, as I said, seems to be in a rather good shape. Profitability of the banks has improved last year. Growth, credit growth and technology contributed to that. Credit defaults are under control. And as we said, liquidity in the system improved, partly as a result of the actions of the central bank. As we saw, term deposit rates went down by 50 basis points and interbank rates went down by 210 basis points. However, at the same time, some indicators need to be closely monitored to further slow down in the economy, the effects from the higher borrowing costs on credit growth, and the uncertain impact of debt classifications triggered by credit bureau. Overall, I still expect the remaining months of 2023 to offer a reasonably supportive environment for banks, with more liquidity injections, as I mentioned, from SBV, with more fiscal spending disbursements, and with a moderation of borrowing costs. As regards TCB, I already explained that we anticipate further pressure on our NIM. We will look to adjust our deposit rates as much as possible to leverage the improved liquidity in the market. But on the asset side, our actions, as I mentioned, are more constrained due to several factors: the strategy of the state-owned banks, the disconnection between asset rate and deposit rates in the market, and finally, our flexible pricing policy. So our NIM this quarter on the last 12 months basis was 4.6%, and you could assume that our full year NIM will be broadly in the same ballpark, and therefore lower than in 2022, where our NIM was 5.1%.
Thanks, Alex. The next question is on some regulatory changes that we've seen recently, and we'll combine several questions together, and this will go to Jens. Could you comment on the latest regulations, Circular 2 and Circular 3 amending Circular 16 regarding the credit institutions' participation in the bond market? What impact do these changes have on the banking sector and on Techcombank's operations and outlook? And then does this impact at all the NPL guidance that you gave in the AGM last Saturday?
Thank you for the question. So first one, I think it is fair to say that we are very glad actually that SBV and other regulatory authorities actually have taken pretty decisive action on some of the key impediments currently faced by the banking industry in Vietnam. And I think the fact on Circular 2 and Circular 3, which are really talking about restructuring of loans, the ability of banks to actually help in the bond market to create liquidity, are probably a little bit more substantial than what market participants might have expected. And so therefore, coming out with such a strong support clearly shows us that SPV and others are trying to really put this behind us and really give all the support they can. So from that perspective, we welcome these measures and really think it's clearly a step in the right direction, and it also gives the support required. For us, again, probably a different one is on the bond market. I think we already had a lot of discussions when it came to Circular 16, but now also and some of the other adjustments. So I think it will help us just to provide the liquidity in the market. Again, I think we will not see such a massive change what we are doing, but I think in overall liquidity in the market will be better. I think other market participants can probably intervene and come and provide required liquidity, and therefore also give confidence to some of the bondholders, and which might have been a little bit more worried. And so I think that should actually help establish market confidence. When it comes to the restructuring of loans, which is rather in line with what we've seen during COVID, and again, I think will help a lot for some of the people who currently have taken out loans on the mortgage side, but also, again, I think on the SME sector and some of the other companies which right now are facing liquidity crunches, cash crunches, because of some of the impacts we've seen in Vietnam, but which are also induced by some of the global developments. From our perspective, it is not changing so much in terms of the guidance we gave. And we had said that a lot of our book is okay. We guided for an NPL ratio below 1.5%. We basically said credit cost should be and maybe a little bit elevated because last year was very low, but again, being all in line. I think for us, probably these additional circulars provide us even more confidence that these numbers are correct. And how it will play out over the next couple of months, we will see. But again, I think it just gives us probably additional and extra cushion when it comes to NPL ratios and when it comes to provisions, etc. So therefore, all the guidance we gave, NPLs not above 1.5% and provision and credit cost under control, and we can probably say even now with more confidence and that this will and that we can actually achieve these results. So from that perspective, not a major change, but again, I think it established a much better regulatory guardrails and also for others in the banking industry. So therefore, for example, what we would also expect that some of the CIC impacts, which we had mentioned in the past, might actually not be as volatile as what we would have expected, because we believe there's more chances for all the other banks as well to restructure their portfolio without actually changing the buckets and the classification of the loans. So overall, very positive on these developments. As I said, not such a major impact to us. It just, again, provides us extra buffer so that we're very comfortable that the guidance we gave can actually also be achieved.
Thanks. The next question is for Jens as well, and it's on strategy. With what happened in 2022 regarding the bond and real estate market, is there any change to your strategy, especially in terms of focusing on recom and the affluent customers?
Thanks for the question. I think the answer is pretty simple. No, there's no change in strategy. Again, strategy, we are not making depending on short-term changes. We still believe, first, there is a huge need for real estate in all sectors. And we know that in the affluent segment, but also in kind of mass affluent segments, real estate investments are the most dominant asset class. That's what people are really looking for. We know that there's shortage of housing in all areas. So we are very, very convinced that being in that market and in that segment, doing it in the right way is actually very important, especially for us, given the fact that we have such a high market share in the affluent segment. So, and that one clear. Secondly, we maintain that just financing all the capital need and for a high growing country like Vietnam cannot be supported just by bank balance sheets. So we need other sources of capital mobilization, and be it capital markets, but even for some long-term funding like life insurance and companies' life insurance markets. So, and therefore, we are very clear that wealth management and development of these products is actually crucial for capital mobilization as well as investments. So again, we understand that somewhere and when these markets develop and some things are going out of hand, therefore need to consolidate. We need to take a breather so that we can actually get to the next growth level and on a more stable and on more stable fundamentals. So that is what's currently happening, and a little bit all coming at the same point in time, while we have the external impact and other factors like the conflict in Ukraine and kind of inflation, etc. But again, that's not changing our belief in the secular trends. And therefore we guided probably this year, we have some headwinds, but we are still very much convinced that these are the right markets to be in. And again, after all the dust has settled, we believe actually that it might actually work in our favor, as we see that those which are really committed to that market, who have the right systems, processes, will probably come out and as winners. So, and we're actually looking very positively into the future, and it's very clear we maintain our strategy and we're committed to these markets.
Thanks, Jens. Staying with Jens on for the next question. At the AGM, the chairman mentioned two things that we hadn't heard from Techcombank in a long time, and these were regarding sharing profits and excess capital with shareholders via dividends, and even a plan to announce a share buyback at the AGM. What was the reason for the change now?
Okay, so is there a change? I think we always maintained that we're looking into and kind of how to best deploy capital. And on the share buyback, and as the chairman of the board of directors had commented on, and we evaluated that because we believe, and it's given the current share price of TCB, which we believe is not really reflecting the fundamental valuation and the earning potential, we saw it as a very good investment opportunity. So, and we were thinking about on proposing some investments, but again, we are clearly waiting for the guidance of SBV how to do that, because that is not completely clear how the how some of the legal regulations which are in the investment laws and can really be translated to banks. So, and we're waiting for that guidance. But as we said, as an investment opportunity, and taking some of the money we have and investing in the own shares would actually be and still is at this price a very interesting investment alternative, which we are clearly evaluating. In terms of dividends, ultimately it really comes down to how do we perform against our strategic plan. We always said that retaining earnings is actually the right move, because as long as we grow and at a 20% and we make profit and at a 20% growth rate, as long as we want to maintain a 15% CAR ratio, we can actually grow in a self-sustained manner. Now, when I look even with the guidance for 2022, and we look into our overall strategic plan, we are running ahead in terms of an overall profit and for the first 3 years, as well as capital retention. So there is some room to actually look into that, and that's what the board rightfully is doing, and always interested in the best interest of the shareholders. So as we're running ahead of our plan, should we actually maintain that because we see additional opportunity over and above the strategic plan, or are we actually better off and to redistributing it? So, and that is the situation and the board is looking at, and given the fact that the 10 years which have been declared as non-dividend period and is kind of over, that is what the board is looking at, that is what the management team is looking at, and if there is an opportunity which is value creating by all means, and we have the means, we will look into that. So with that, I think there's not a change in policy, but it's just that right now, and with more visibility and certain circumstances in the capital markets, we just explore all the opportunities to increase shareholder value.
Thanks, Jens. The next question is for Alex. The bank is planning for 15% credit growth subject to the final SBV quota. However, we've seen quite weak credit growth from other banks in the first quarter, and some brokers have questioned if the sector will reach the 14 or 15% growth target of the SBV. What is your view on for sector credit growth and the final SBV quota for this year?
Thank you for the question. So, compared to the previous years and talking about the banking sectors in general, there is no question that the environment is less supportive for lending activities. Credit growth, as a matter of fact, in the first quarter was estimated around 2% only, which is significantly lower than in previous years. There is the impact of the economic slowdown, the higher borrowing costs, and also the uncertainties in the financial environment, which impact investment decisions. It is therefore possible that the sector credit growth may not reach the 14 to 15% target set by the SBV at the beginning of the year. However, I don't think we should read too much in the results of the first quarter. For one, interest rates, as you know, are on a downward trend, which should help support credit demand and boost investments in the economy. And there are also the measures that Jens commented on earlier, taken by the authorities, particularly Circular 02 on debt restructuring, which will have the same effect of supporting asset origination and economic activity. Now, when it comes to Techcombank specifically, we see continued demand for credit from our customers, particularly our corporate customers, which means that the overall credit volume is not the issue. What we are trying to do, however, is to balance the growth of our credit books with the achievement of our objectives in terms of margins and in terms also of segment diversification. Until now, as you have seen, the performance of our books and asset origination is rather healthy, but I recognize that the months ahead will remain challenging.
Next question is also for Alex. Regarding the guidance. So could you explain why the guidance implies a 14% year-over-year decline in profits for the year? What's driving this decline, and what do you expect in terms of profitability from TCBS, TCC, AMC, and the bank standalone? And what are the NPL and provision expenses for each of those entities and the CIC impacts, and then also, how NIM factors into that as well.
Okay, it's a multi-layered question, thank you. But at the same time, I recognize what many of you may have these questions on your mind. So it's probably good first to take a step back and put this year's guidance into perspective. So at the end of 2021, if you remember, most of Techcombank's profitability and efficiency metrics were around 1 to 2 years ahead of our 5-year strategic plan. And at that time, the net interest margin of the bank was much higher due to an unusually low cost of funds driven by the abundant liquidity of the COVID pandemic. During 2022, and particularly during the last quarter, we saw a trend in the opposite direction with the combined effect of higher term deposit rates and declining CASA balances. We also experienced headwinds in the bond and real estate markets, where we had built strong commercial positions at the bank, and this caused our net interest margin to contract and impacted our fee income streams, particularly for bonds as well as investment banking products. So as we said, we expect 2023, or at least the first half of 2023, to present a similar pattern, with continued pressure on our net interest margin and muted performance on fee income, with a low customer risk appetite for bonds, for funds, and for stock investments in general. But beyond this, we will apply also a flexible pricing policy to support our customers. So all this will exert pressure, for sure, on our earnings, even though we will look to recover, as I said, the pricing concessions when the cash flows of our customers improves. So overall, 2023 is going to be a year of consolidation, but if you look at the accumulated profits since the start of our strategic plan, we are ahead of our targets.
Thanks, Alex. There's a follow-up question just to ask a little bit more on NIM. And, you know, does the guidance imply that the NIM would be lower than the 5% that was provided in the year-end analyst presentation 3 months ago? And what is your NIM projection for this year?
Yeah, so as we said, there is clearly an anticipation of continued pressure on our NIM, which means that the NIM in the second quarter will probably also reflect that. Now, we also anticipate that at the we restore the position on CASA, and as the pressure on term deposit rate starts easing, the cost of funding will start improving, and therefore we should see the NIM recover in the second part of the year. As I said, our last 12 months NIM was 4.6% at the end of the first quarter. I would expect our full year NIM for 2023 to be roughly in the same ballpark.
Thanks. And the next question is for Jens. CASA has traditionally been a great strength of Techcombank, but has declined in 2022. What are the reasons, and what are you doing to gain back your CASA position? And do you still expect to reach your 55% target by 2025 year end?
So thank you for the question. They're basically, and I think Alex talked a little bit about it, but maybe I can shed a little bit more light. There are, and from our perspective, three main drivers or segments which are adding to our CASA. First one is the affluent segment, which is very important, and their CASA is mostly driven by their ability to invest in other asset classes. So really, CASA here is liquidity, which comes from switching in and out of certain asset classes, real estate, bonds, stocks. As all these investments dropped during the second half of last year, and that basically evaporated. And therefore, as this is strictly correlated, and as this one came down, and a lot of the money just basically went away and went into term deposits as an alternative. So that is why you see, while CASA was going down, actually our term deposits went up quite massively. The second one is a strong correlation between credit and CASA. So in the absence of credit, which were a little bit the case, and again, second half, and because the capital markets were going were not functioning at the same point in time, and there was also quite a restrictive policy in quarter three of SBV in order to react to some of the inflationary tendencies. And people used CASA and deposits for self-funding, especially business owners, and which are also, to a certain extent, affluent customers. And therefore, credit went down, CASA went down for self-financing purposes. So again, that hit us. And third one is a lot of correlation between transactions as a main operating account and CASA for just pure liquidity reasons. And that actually remained pretty stable. So therefore, again, looking forward, as the risk profile, again, probably start changing a little bit, as people start reinvesting in other asset classes, as confidence is coming back, we will see some of the affluent CASA, which is residing in CASA as a liquidity pool for entertaining investments will actually come back. So we'll go out of term deposits also as term deposits becoming less attractive. And so we are clearly positioning ourselves as the leading wealth management player. We invest a lot in the right products. So that is one area, and we're pursuing in order to make sure it's coming back. And as credit comes back, therefore less need for self-financing and self-funding, we will see again that on the business banking side, corporate banking side, we will actually see that some of the CASA is coming back. Again, we're doing a lot in order to acquiring new customers, and especially on the business banking side, corporate banking side, households and businesses. And because, again, as we see an uptick in the economy, we will see that inventory starts increasing and CASA will start coming back as turnovers and start coming back. And then transaction banking already quite a lot, and Alex has talked about, we're doing a lot on the creating transaction banking platforms, investing a lot in our technology stacks, but also looking after new to bank customers. So on average, we increased customers per year by maybe 1 million new customers every year. We really try to double or even triple that amount of customers based on our digital strategy. So again, different segments and different strategies. I think some will depend on how the market turns, but the ones which are clearly within our capabilities, especially around transaction banking, that one is we never lost, and we actually continue to increase that. So therefore, if the question is, are we confident that we can go back? Yes, and I think we went down from maybe 46 to 32 within 15 months. So there's no reason to believe that within 15 months we can also not go the other way and around. So we maintain actually for our strategic plan from until 2025 a 55% CASA ratio, and that has not changed.
Okay, thanks. The next question also for Jens. If we look at the Group 4 loans, why did they increase? We saw a big increase in the Group 4 loans at the end, from the end of the year until the end of the first quarter.
So that mostly comes out of our retail banking book, and in our retail banking book, it's actually quite a bit on the credit card side. And we had said beforehand we want to increase that portfolio, and we have increased that portfolio. And as you see, the overall profitability of our credit card business, which reflects in fee and on the fee income, but also actually on the interest income, it's actually very healthy, and we're very happy about how this book is developing. That at the same point in time, we will get higher NPLs and higher credit cost, and that was expected. But again, if we look into an economic value added, and it's very clear that this still is very, very beneficiary to our value creation. So expect some of these numbers to go up. But again, I think we are looking at it really from a risk return perspective, and that is still very, very healthy. Some of that is also CIC impact. So if we really look organically, it's probably significant, or it's less by maybe 200 billion or something like that. But again, as I said, it's very much within our expectation, and it's managed accordingly.
And on the retail loans, Jens, could you elaborate on why the total balance of retail loans actually decreased in the first quarter?
So what we saw is as the interest rates increased, especially on the mortgage side, and first, those customers came out of their moratorium period, and where there are a lot of subsidies on the interest rates, they basically decided to pay back early and didn't really get into kind of a normal mortgage. At the same point in time, there was not a lot of demand for new mortgages. So therefore, we just saw less inflow than early retirement redemption, and that brought down the retail portfolio. So it's mostly around the mortgage side, and they're purely induced by the relatively high interest rates as liquidity became very, very tight. So it's unusual to what we had seen in some of the years beforehand. So probably that will change as interest rates are normalizing again.
Jens, just follow up to that. The wholesale banking book actually increased in the quarter, while SME and retail was slightly down. Is this something that is a general trend for the whole sector, or is it specific to Techcombank?
So first, as we had said, our strategy is actually very clear. Our strategy is we want to diversify away from the corporate side. We want to build up our SME and our retail portfolio. That's exactly what we did last year. And however, and what we're also trying to do right now is think about timing and what to do exactly when. And firstly, usually we're trying to actually use the credit quota which has been granted to us as quickly as possible, because there's a lot of demand from customers, especially on the corporate side. So that is why we disperse very early in the year. At the same point in time, given the high interest rates, and we don't see so much demand from retail customers, we don't see so much demand from SME customers, while, and especially also on the recom side, and we made this comment in the past, a lot of our customers actually have projects in good standing, good legal standing, so they're actually continuing in their development progress. So, and they actually continuing in developing, and so that is where the credit demand is. And then as the market comes back on the retail side, as interest rates are coming down, like in the past, we will shift that corporate portfolio as units become ready into retail mortgage loans. So again, there's a little bit of a timing difference, because right now it's less of a demand like what we've seen probably in the first half of last year, while we're still seeing a lot of demand from corporate customers to continue their real estate development. So again, it is probably more right now a timing effect and special market circumstances more than strategic intent. And therefore expect, as the market returns a little bit more to normal, that again we will try to expand the retail book and as well as the SME book more than the corporate book over time.
Thanks. The next question is for Alex on operating expenses. Alex, you had some reclassifications in OpEx. Could you explain what changed and why?
Sorry. So very happy to explain. We essentially reclassified 357 billion of debit card cashback from OPEX to contra revenue. This is consistent actually with international accounting practices for this category of costs, where there is a direct and proportional link between revenue and expenditure. And therefore, we believe that this was the right thing to do from an external reporting perspective.
Thanks, Alex. The next question is, at the end of 2022, the bank revised the NPL to 0.7% from 0.9% was announced earlier. Could you explain the reason for this and what does this mean for the NPL at TCBS?
Yeah, thank you. So we touched on this in the press release. The margin loans written by TCBS now follow the same presentation as in TCBS accounts. And the objective is to ensure consistency of reporting and also reflect the specific nature of these loans. So as you know, margin lending activities are intrinsically different in the sense that the collateral that the bank holds, again, the exposure can be liquidated to cover the bank exposure, and therefore the primary risk to which we are exposed is more of a market risk nature rather than a credit risk nature. So specific disclosures have been added to the financial report in order to explain the impact of the change of accounting policy and also provide additional transparency on the delinquency behavior of our portfolios with a new split between the banking and brokerage businesses. So again, we believe that this new approach, which has been discussed and approved with our auditors, improve the quality of our external reporting.
Thanks. The next question is for Jens on Banca. Why did your Banca fees decline, and could you provide some outlook for the rest of the year in terms of the environment?
Yeah, thank you for the question. I think all of us who are operating in that market, I think we've seen a lot of noise actually on the life insurance market, and there is a lot of concern right now about mis-selling and all of this. You combine that with kind of a dampened economic situation where people are saying, do I have actually money to invest or right now to procure protection or invest into insurance? You see actually that the whole market is pretty much down. So I think we've seen overall that the market is down 12% and we are down 11%. So it's mostly a market effect more than anything else. We actually believe that the way how we set up our business model, and which is much more customer-centric, need-based, and controlled by our own staff and not kind of referred to agents from insurance companies. We actually believe that as the market recovers and as there is a little bit more differentiation and there's much stricter guideline in terms of securing the right selling standards, that actually will be in good standing and that we will actually come out of that pretty strong. So we have quite some aspirations this year, and we do a lot of and have a lot of efforts in really improving our entire business model end to end, from customer understanding and the way how we conduct interviews and how we actually do and give advice and how we really making sure that the right customers get to the right product. We're also expanding our channels in which we can deliver solutions to our customers. So if we take this all together, we believe actually that we will have a stronger year than what we had last year. But again, right now, in first quarter, there's probably some, again, market effects, which is hard for us to overcome on our own. But again, on relative terms, we should actually still be stronger than the market. And as I said, I clearly hope that we want or that we will be better than last year.
Thanks, Jens. We have a final question, and this goes to Alex on ROE. The ROE has been lower in recent quarters and below the 20% ROE guidance that you had given for the 5 years. Based on your PBT guidance for 2023, it seems that the ROE will also be around 14%. And what is your take on this? And could you give us some reasons for that?
Yeah, thank you. And first, I agree with your estimate for the ROE calculation for 2023. The way I would look at it, that for me, it's still a respectable performance, considering the magnitude of the headwinds that we are facing and also the size of our capital buffers. Other banks in the market, as you know, are operating with a much lower capital buffer. And if we follow the same approach, our ROE, and you can do easily the calculation yourself, would still be at 20%. So I think it's important to compare like for like. And looking ahead, so our target is still 20%, which looks to me and to the management team like a very achievable objective for the next phase of the cycle, considering that investors will become more pro-risk, that our cost of funding will go down, and considering also that we will recover our pricing concessions and stop accumulating capital. So within these, all these factors are a number that we can directly control, as Jens explained. So in short, we just stick to our target of 20% ROE.
Thanks, Alex. This concludes the first quarter financial results presentation. The presentation and replay link will be posted on the IR section of the website soon. Please contact the IR team for any additional questions, and we look forward to speaking to you again in 3 months.